All right. Excuse me. I'd like to take this opportunity and discuss question number 2 on your equity valuation homework. Okay. All right. Nike had a sales of $25.3 billion in 2012. Suppose you expect the sales to grow at 10% in 2013, but then slow down by 1% per year to the long run growth rate that is very characteristic of this apparel industry, 5% by 2018. Based on Nike's past profitability and investment needs, you expect EBIT, that's 10% of sales, and increase in net working capital, that's 10% by any increase in sales, capital expenditure, that is equal to depreciation expense. So this is actually very similar to the King's Cole Corporation example we did in class. All right, but there is something new here. Okay, if Nike actually has $3.3 billion in cash, $1.2 billion in debt, 893.6 million shares outstanding, tax rate 24, weighted average cost of capital 10. If that's the case, what is the estimate of the value of Nike's stock in early 2013? Okay, and part A, that's part B. Suppose you believe Nike's initial revenue growth rate will be between 7% and 11%. Okay, which grows always slowing linearly to 5% by 2018. Okay, what range of prices for Nike stock is consistent with this forecast? So the answer is if the revenue growth rate is actually 7%, the price should be 46.89. If it is 11, then it's 51.53. If it is anywhere in between, then the price should be between 46.89 and 51.53. Okay? All right, that's part B. Part C, suppose you believe Nike's initial revenue EBIT margin will be between 9 and 11% of sales. So if that's the case, what's the range of the price? All right, that is consistent with this forecast. And also, suppose you believe Nike's weighted average cost of capital is between 9.5 and 12. All right, if that's the case, what is the range of the stock price? In other words, what's the lower bound, what's the upper bound? And part E, this actually is putting all the parts together. This is saying, hey, what range of stock price is consistent if you vary the estimates, like in part B, C, D at the same time? So the answer is, well, the lower bound is going to be 30.69. The upper bound is going to be 62.98. Okay. All right. So that is the different parts, and this is a perfect example for modeling. All right. So what I would do is I'm going to actually build. This apparently is doing the free cash flows valuation. So I'm going to build a timeline here. I'm going to start from 2012, and it's going to slow down to 5% by 2018. So I need to have 2018 at the list. Okay, so I'm just going to have a bit more than that. And I can also build my period timeline here. 2012 is period 0. And this is period 1 for 2013, and so on and so forth. Okay, and let's just look at the question. And so the first one is sales for 2012. That's 25.3. So let me just put down 25.3, and then the sales grows. And that is actually 10% in 2013, and then it's going to slow down linearly by 1% per year. So that means I'm going to do 10% minus 1% here, okay? And so it's going to be 9% for 2014, and by 2018 it's going to be 5%, and thereafter it stays at 5%, okay? All right, so that's the stabilized sales growth, okay? That is, so if that's the case, I can calculate sales in the future years. $25.3 billion multiplied by 1 plus the sales growth rate for 2013. I can get the sales for 2013, all right? Okay, so that's a very minor calculation you can do immediately. All right, and then you have the EBIT. And here you have the EBIT margin. EBIT margin is actually 10% of sales. And if you look at, for instance, part C is actually saying, hey, what if you actually change the EBIT margin? All right, so it looks like we're trying to model the impact of the EBIT margin. So if that's the case, it makes sense for me to actually just devote, one cell for EBIT margin. All right, so that is going to be 10%. All right, so we just put down 10% here. And now I can actually calculate my EBIT, which is nothing but the sales multiplied by the 10%. Okay, and I need to lock this down. All right, so that way I can actually change this later to, let's say, 9% or 11% in part C. Okay, all right, so let me copy this across. I get all the EBIT. And now let's look at the next thing here, which is increase in net working capital. So increase in NWC, and this is actually based on the margin, which is actually 10% here, 10% of any increase in sales. So we're not trying to model this, so we're just going to use the 10%. Okay, so let me just do the sales for 2013 minus the sales for 2012. That's the increase in sales. And 10% for that is devoted to the increase in net working capital. So yes, that is, I'm putting down 10% here constant. I'm not putting down a cell for the 10% percentage. So that way, we're losing the flexibility of modeling this 10%. Okay. All right. So let's look at capital expenditure, and they always cancel against each other. So capital expenditure minus depreciation, that's 0. All right, so if that's the case, you can actually look at the free cash flows to the firm. So in this case, it's going to be EBIT, which is this number here, multiplied by 1 minus the tax rate, which is 24%. And then you do plus depreciation minus capital expenditure, so that part is gone. And then you do increase in net working capital. And so if you remember the definition, increase in net working capital is actually, do you subtract or do you add? Right? You subtract or do you add? So, all right, your increase in net working capital, it should subtract, okay? So that is your free cash flow to the firm for 2013. And I can copy this across. And so now I just need to look at the free cash flow to the firm growth rate. I want to look at when this thing actually stabilizes. All right, so this is one way to calculate the free cash flow growth rate for 2014. All right, so that's 10%. And let's copy this across, and you see that yes, it's going to stabilize at 5% starting from 2019. So if that's the case, I can actually go ahead and calculate the terminal value. Here, the free cash flow growth rate starts stabilizing at 5% from 2019. So your earliest terminal value you can calculate is 2018, and so that is the next period of free cash flow divided by the cost of capital, which in this case is, what is the cost of capital here? Let me just look up the number here. The cost of the capital is 10%. That's the WACC. But later, we're actually going to look at the weighted average cost of the capital ranging from 9.5 to 12 in part D. So it makes sense for me to actually devote a cell for that. Okay, so I'm just going to take a step back. And I'm going to say, all right, this is the WACC. So right now we're putting down 10%. And so anywhere I need to use the 10%, I use the cell reference. Okay. So that is the next period of free cash flow divided by WACC minus the G, which is the 5% here. Okay. All right. So that is the terminal value. That's $58.36 billion. This actually stands at 2018. So now I can actually get the cash flow per period. So this is the terminal value plus the last period free cash flow, and I can copy to the left, pick up all the free cash flows, and now I can just look at present value of all cash flows, which in this case is the enterprise value. Okay, so we're just going to add up the present values here. Actually, I have not done the step-by-step discounting, so I'm just going to use the NPV function here. This is equal to NPV. The discount rate is 10, and these are the future cash flows. So that will get me 42.88. That is the firm value here. So now I can actually get market value for equity. All right, so that's going to be equal to enterprise value minus debt. The company has $1.2 billion debt plus cash. The company has $3.3 billion cash. So the market value of equity should be 44.98. And now you can actually look at the share price. All right, so the share price, this is now 44.98. This is actually in billing. So this is divided by number of shares outstanding, which is 893.6. This is in milling. So after you're done with that, you should multiply that by what? So you're going from milling to billing. So it's the 1,000. All right. So you need to multiply that by 1,000. So that is 50.34. So this is saying the stock price in early 2013 or end of 2012, that should be $50.34. All right, this is a part A. Okay. Now, part B, this is saying if the initial revenue growth is going to be between 7 and 11, and it's always going to slow down linearly to 5, if that's the case, all right, so let me just look at part B. All right, so that is part A, and just let me just move this up, and this is part A. So what I'll do is I'll take everything here, okay, all the work I did for part A, and I'll just put it down here, all right, and everything still, copies through. All right, so now we're saying, hey, the initial revenue growth is going to be 7 and 11, and here we're using 10. So I'm just going to say initial, I need to model this now, all right? Initial revenue growth. So how about we use 7 here for the moment? All right, 7 here for the moment. And now we have to make reference to that 7%, okay? But you notice that if you just, slow down by, if you slow down by 1% as we did in part A, then by 2012, by 2018, it's not going to stabilize at 5%. It's actually going to stabilize at 2%, and that is problematic, okay? So what should we do? We should actually build a strong formula and a copy across here. So the catch is that you're not going to slow down by 1% each year, because if you do that, you're going to actually stabilize at 2. So what I'm going to do here is I'm going to look at, the gap, which is the 7%, okay, minus the 5% stabilized rate. And I have, how many years do I have to, slow down? So I have 14, 15, 16, 17, 18, so that's 5. So if I do it this way, all right, actually I need to lock down this 7% here. So if I do it this way and copy across, would that do the trick? Yes. All right, so that actually is going to lead me to slow down rate of 5% by 2018. So you see that what I'm doing here is essentially I'm taking the 7%, which is the starting point. I'm taking the ending point, which is 5%, and I'm looking at how many years I have. So I do the average slow down size for each year, which is nothing but the 7% minus 5% over 5. So in this case is 2% over 5, which is 0.4. So each year you slow down by 0.4, given the 7%. All right. So what if I change this to 11? Will that still work? All right, so if I change this to 11, yes, you're going to slow down to 5%. So this formula here is actually a very good formula for you to think about, for you to actually build, okay? All right, so let me get this back to 7%. And what else do we have? So no, we don't have anything else. So that actually gives us the answer. So, revenue. All right, so I can now, look at the answer here. 7% initial, or I should say, at 7% initial revenue grows. And Excel doesn't like that, so let me just get around that. So price is equal to, okay, what's the price? 46.89. All right, so let me just put down the number here. All right, let me copy this and let me paste it here. All right, so now at 11, let's look at what is the at 11, what's the price? So I'm going to go up here and change this to 11. All right, and everything else is the same. So yes, the price is now 51.53. Okay, so let me just put down the number here. All right, so that answers part B. In other words, I'm trying to build a placeholder so that it can actually manipulate all the different assumptions, and you're going to get the different prices. Part C, well, I don't need to copy down part B anymore because I just need to change the EBIT margin to 9 and 11. And in this case, the initial revenue growth, I should change this probably back to 10%. Okay, so change this back to 10% and change the EBIT margin to 9. All right, what's the answer? The answer is, does that change actually? So let me look at this one here. All right, so now I have to clean up my cell reference here because it's actually still locking down the 10% I did earlier from part A. So I should probably change this to the 9% here and lock it down. And let me just copy across, okay? And all the calculations should follow. And that is 45.18 if you're using 9% EBIT margin. So let me just put this down, okay? At 9% EBIT margin, price is equal to, all right, 45.18, all right? And can I just copy and paste it here? All right, and change this to 11. Okay, so at 11, let me look at the price here again. So let me just change this to 11. And this is now 55.50. And yes, that's the answer you saw on your homework. All right, so that is part C. Okay, part D, this is talking about the WACC. Okay, so part D. All right, so this is saying what if the WACC is actually 9.5 or 12, right? So at 9% WACC, what is the price? Price is equal to, and at, excuse me, not 9.5, okay? 9.5, and this is 12. All right, so let me get back to part B here, and let me just revert the EBIT margin to 10%, okay? And I'm not looking at WACC, which is 9.5, and it's still showing as 10, so I'm not going to show the decimal. All right, so 9.5, the price should be, what's the price? 55.75, okay. 55.75. All right, so now let's look at 12% of WACC. Okay, 12% of WACC. Let me change this to 12. The price is now 36.44. Okay. All right, so now that's part D. Part E, this is asking, hey, if you actually change those things at the same time, meaning if you change the WACC, change the EBIT margin, change the initial revenue growth at the same time, what is the lower bound? What's the upper bound? All right, so you have to think about the highest price occurs when, first of all, WACC is what? Lowest at 9.5. Yes. And EBIT margin is at highest. That is what? EBIT margin the highest is 11% in part C. Okay. And initial revenue growth. This is actually going back to part B. This highest is at 11. Okay, so if that's the case, let's look at the price. Okay, so now I know that I just need to go back to part B and change everything as we said, because we're trying to figure out the upper bound, the highest price. Okay, so the WACC should be set to 9.5, and initial revenue growth should be 11. EBIT margin should be 11. Okay, what is the price? All right, so the price is 62.98. All right, so let me just put this down here, 62.98. And let me just copy this note. The lowest price occurs when WACC is highest, and that's going to be 12%. And EBIT margin is the lowest, and that should be 9, according to part C. And initial revenue growth is lowest at 7. Okay, so if that's the case, what's the price? All right, so let me just look at all these things again. Now, WACC is 12. Initial revenue growth is lowest, 7. The EBIT margin is lowest, and that's 9. All right, so what's the price? The price is 30.69. Okay, and that's the answer you saw from your homework. All right, so that concludes my discussion for number 2. Okay, you see that you have to be able to model all these things as I did for part B, and this was actually borrowed from part A, but I have to clean up the absolute cell reference here in order for me to actually get the numbers right. All right, I hope this is useful.